Well, let's move along and talk industry specifics analysis now. And for one last time this year, let's go and chat about uranium. The commodity has been recovering from a decade-long bust, but is next year the year to buy up the local uranium stocks and potentially some ETFs as well. For his technical reader on the space, we welcome back Jason McIntosh from motiontrader.com.au, live here with us in our Studio B at Barangaroo. Jason, thank you for joining us once again on Ausbiz. Before we go and get into the specifics about the uranium market and those individual names, could you just provide our audience a reminder, how do you operate at Motion Trader? How do you go and pick up on stock selections?
Well, hi David, thanks for having me on. It's look, Motion Trader is basically a momentum-based algorithmic stock identification service. So what I'm doing, I'm using algorithms to identify momentum in the market, and that's triggering ideas and opportunities where we're seeing price movement, and then that lets us zoom in and have a closer look at the stocks which are on the move. And then of course it's about applying risk management to exit these stocks at the appropriate time. And the great thing about this is it gives us lots of opportunities and lots of ideas, and that's what we're going to talk about today, some of the ideas which have come through this identification process through momentum.
All right, before we go and get to the momentum case at the moment for individual stocks and potentially some ETFs in the space, I just want to get the investment case that's underpinning uranium. So, of course, a fundamental perspective, it's not what you do as a fallback, but what are you looking at from a fundamental perspective, the investment case next year for it?
Yeah, look, uranium's a really interesting situation. It's been basically in a decade-long bust. And if you go back to 2004, it was trading at around $10 a pound. And by 2007, it was up to $140 a pound. So it was a huge boom. Then the GFC came in and the price plummeted, got down to around $40 a pound. And from there, there was a recovery into 2011, back to $70 a pound. So we're still off 50% from the highs. But what happened then, we had Fukushima. We had the Fukushima nuclear accident. And like at the time, Japan had something like 54 reactors. And over the next 2 years, they shut the whole lot down. And 12 have been permanently closed, and a whole lot of other reactors still haven't come back online. So you had this big contraction in demand. And at the same time, there was a supply shock in that the world's largest uranium producer, Kazakhstan, they were ramping up production. And the world's largest listed company, Cameco, they were also bringing new supplies online. So, we talk about a perfect storm, and this was pretty much one of those times where demand and supply were both being hit, but in the wrong ways. So, look, that devastated the industry. They're from something like 500 uranium plays in 2007. Currently, there's said to be something like around 50, and some of those aren't investable because they're state-owned entities. So the situation we have now is it's a small and a rather unfollowed segment of the market, and there's a real demand supply story building. So demand's forecast to increase over the next 10 to 20 years. But the supply's not there currently to meet that demand. So we've got this structural supply deficit in the market, and the way to combat that is naturally to bring on new supply, open up new mines. But with the price the way it's been over much of the last decade, it's not economic to do so. And yes, look, a lot of the miners they've actually been cutting production. They've been mothballing mines because the price is just uneconomic. Half the mines are not running at a profit currently, so it's not really a productive backdrop for doing that. So this is the challenge I think for going forward with supplying the utility companies that use uranium with uranium, is that you've got to get that supply. And look, on the demand side, that's just this year we've gone above the nuclear output for what it was. It's above where it was pre-Fukushima. So global nuclear output's increasing, and it's back to those levels. And you look at where's that come from? It hasn't come from Japan because a lot of those reactors are still shut down. It's coming from new reactors opening. And the World Nuclear Energy Association, they say there's something like 52 reactors currently under construction around the world. It's worth about $500 billion. And there are another 450 or so which are either planned or proposed. Now, a lot of these may not come online, but even if a portion of them do, there's a lot of potential demand coming in. And the supply side, well, as we spoke about, it's currently not equipped to meet that demand.
Mm-hmm.
Being a small industry, it's look, the investment dollars start to come through. Well, it opens the potential for some pretty good gains. And
so, Jason, let's go and get to some of those companies that the momentum indicators have gone and triggered on your platform. Now, a lot of people, when they think of uranium here in Australia, they think Paladin. Where is that at the moment on your list?
Yeah, look, Paladin's a really interesting stock. 2004 it was trading at 10 cents, below 10 cents. By 2007 it got to near $10, and then over the next year it was fell back down to below 10 cents. So it's not so much a story of a stock implosion, but it's an industry implosion. And you'd find Paladin's situation, it's quite common when you look at the share prices of the uranium stocks globally. And look, Paladin, it's in the All Ordinaries, it's not in the ASX 300. And look, over the last few years we would have been talking about how this was a disaster stock. It's really only this year that it's starting to get some momentum into it. And it's 170% above its pre-COVID high. So, but look, it's coming off a very low base. So people here, look, it's up 170%, think, oh, look, I've missed it, it's too high. But compared to where it's been in the past, it's still down the bottom. And market cap's around $500 million. They've got a mine in Namibia, which is a uranium-friendly jurisdiction, and they've also got a large resource base in Queensland and WA. You can't mine in those states at the moment. Haven't been able to mine there for a long time. But look, there's also an interesting green argument to uranium over the next few years. So look, when we talk uranium or nuclear, I think a lot of people, they instantly think either weapons or accidents, and they go to Chernobyl or Fukushima, and so uranium's been the bad guy on the block for a long time. But when you look at the facts, it's actually one of the safest, cleanest and most reliable sources of energy.
Mm-hmm.
So if we're going to make a good crack at reducing emissions over the next couple of decades, there's an argument that you do come back to nuclear, because at the moment coal is the main source of electricity generation. Solar and wind, they're not going to fill that void anytime soon, I don't think. So there is that potential there for the nuclear to come through. So Paladin, I think, is well placed, and if we do see that change of sentiment towards nuclear, then the prospect of these resources in Queensland and WA, well, then they also come into play.
Jason, we're starting to run a little bit short on time, but is there any other way that investors out there can go and play the uranium trade? Is there any names or ETFs that have popped up on your radar? Yeah,
look, just quickly, a stock which recently came up on my screens is a company called Deep Yellow. It's ASX listed. They have a resource base in Namibia, which is uranium friendly. Another way to do it is through an ETF. Now, there's no ETFs on the ASX. There is one on the New York Stock Exchange. It's only got a market cap of $40 million, which is surprising for that market, but that's just the space that we're in with uranium. It's fairly small. It's called North Shore Global Uranium Mining. The ticker code is NRMN, and it's got a portfolio of around 29 stocks. Paladin and Deep Yellow are in there, and Cameco, the largest, that's its largest holding, and that's probably a good way to get exposure over the whole industry, because there aren't a lot of players in the market to get that exposure. I've got an investment in this company myself. I think it's a very positive asymmetric risk reward trade. Because we're so down and out, the risk is relatively low, but the upside is quite substantial over the next few years.
Certainly an area that a lot of people on our program have been paying very close attention to. I'm sure that will probably continue into the new year. Jason McIntosh from motiontrader.com.au. Fantastic to go and have a chat, Enjoy your Christmas and New Year, and we'll speak next year.
Thanks, David. You too.